Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome back to the video. In this one, I'm going to be going over one of my favorite pullback strategies, and that's using multiple time frames to our advantage. Now, before we go in and understand why, really the big thing that I like utilizing is multiple facets of confirmation. When we create a major level of support or resistance, say off of the 60-minute chart or the 15-minute chart, we're creating a zone that for potentially 6-7 hours, potentially a day, multiple days, that the market could be responding to a zone. So we have to be realistic, right? If we're going to be looking at a major zone of interest like a 15-minute chart or a 60-minute chart, trying to figure out where we're going to be getting in by looking at that chart is almost impossible, unless you're just going to slap the buy order right at the top. So what we can do instead is create a structured situation where we have a repetitious pattern like we're always looking for. We have all of our rules satisfied, we have everything lining up, but once the market starts traversing its way into that zone of interest, we then go from this 15-minute time frame or 60-minute time frame or whatever it happens to be, to a fractal time frame, which is usually a quarter of the size, a third to a quarter. So a 15-minute chart may look at a 5-minute chart, or a 2-minute chart, or even a 1-minute chart. A 60-minute chart anchor that's creating a zone here may look at a 5-minute zone or even a 10-minute zone. So once we have our zone of interest, in this case, if we're measuring off of the highs, the trend is obviously down. But if you look internally, we have an L1 into an L1, into an L1, into an L1, into an L1. We have a repetitious pattern that we talk about over and over again. There's an entire section dedicated to it in the Day Trading Academy over at SSFTG. In fact, it's everything about this, right? We've got this continuation. It's over and over and over again. So we're looking for the market to take a little bit of a break. This happens with every strong trend where it goes and goes and goes and goes. It finally rests. It takes a break, and usually when it rests, it comes back to a zone of interest that's usually relatively repeatable, in this case, the L2. So this is our zone of interest from the 15-minute perspective. Now, do we know that the market is going to come back up there and respond to it at the top or the bottom of that area or anywhere in particular? Not necessarily, but what we can do is zoom into those faster time frames and see how did the market respond. So let's go into a faster time frame. I'm looking at a 15-minute chart here, so we'll go to a 1-minute chart instead. And let's see if we can find where that red box is. Let's go. There it is. So when the market begins navigating into this zone of interest, obviously, if sellers were to have just sold smack at the top, it did work, right? I mean, they barely took any heat. It worked out pretty straightforward, and there wasn't a whole lot that really they had to concern themselves with. But when the market came back, the secondary bounce was even better. That's where we really found the market holding true. But what we want to really look for is these repetitious patterns and things that we can set up in terms of a zone of interest. We know that here in this giant red zone is a sell area, but when we first approach it, look at how the market looks. I mean, the market's screaming to the upside. It's very difficult to want to be the first one to the party. Yeah, in hindsight, it worked phenomenally well, right? I mean, beautiful drive to the downside. And as far as an actual risk perspective goes, I mean, they probably got like a 7 or 8 to 1. But let's be realistic here. Do you really want to be selling when the market's looking like this? That's tough. That's really hard to do. So instead, what we can wait for is an optimized entry reason, a pattern, something that takes place coming out of this area that tells us that we've got something going on. Now here, we initially responded to it very aggressively, and then we had a lower high, but they failed to really continue. It ended up going into a higher low and reversing up to another new top. So when we got up to this high, we've got this really nice wedge structure. Depends on how you want to draw it. Either way, we've got a nice little wedge structure. And we break aggressively lower. Now, for the bulls, if they were going to get this to continue back to the upside, then realistically, we should have expected them to hold with, higher lows, higher POCs, etc. But what ended up happening? The market came back down and shut down even the POC. Like, not really anybody showed up there. It bounced for a couple candles, I guess. But really, this is the zone of control. And if the buyers bought this and they rallied to the upside, I have to assume that they got some targets filled. I don't know what their targets may have been. It looks like it was about a 2 to 1, or at least pretty close. Yeah, we can measure them out. They got their 2-to-1 objectives filled. And once their 2-to-1 objective was filled, nobody came back into the party. Well, I wonder why. This is a massive zone of resistance. So when we come back to this area, now we have something to work with. Anything from basically here up to here is a zone of resistance that the market's going to want to sell into, knowing that it doesn't have to risk anything above this high or the trade is invalid. We have our zone of resistance, check mark, but let's narrow this down. Now we have our pattern, check mark, check mark. Could you wait for more patterns and more setups and order flow and a million other things? Definitely. But this is how you really create a strong 1-2 punch to get everything in your favor. And that way, if the trade doesn't work, which is going to happen sometimes, welcome to life, at least you know that you did everything correct. And that's all we can really ask for as far as traders. Just follow the plan, execute correctly, and, well, the market's going to do what the market's going to do. We just have to protect ourselves from it. But hopefully this gives you a little bit of insight in how to narrow down these areas of interest. You don't have to just stick to one time frame, and in fact, it's likely a detriment if you do. If you have any questions, of course, feel free to shoot me an email, jhb@ssftg.com, or drop them in the comments below, and I'll get them taken care of from there. Otherwise, enjoy the rest of the day. I hope you had a great trading day, and we will see you all in the next one. Thanks.